All right, so our moderator today is Chad Miller. He's our new board member, one of the new board members here at the Corona Chamber. And so we're going to have him come up. He's also the director of contract manufacturing for the American National Manufacturing Organization. Let's please welcome Chad Miller as he's going to host this next part.
Awesome. Great. Thank you, John. Thank you guys for all being here this morning. Good morning, Corona. So today we're going to be talking about some fun stuff that we all love. You know, April's coming up and it's tax time. So we have some great guests today that are going to share with us about this whole new thing going on with taxes for 2018. So I know we're all excited about that. So we're going to first welcome up Ash Shenouda, who has been, come on up, Ash, who's been a CPA for over 25 years. He opened his own business in Orange County in 2003, and he established his Corona practice in 2006. Ash's specialties are in taxation and audits for nonprofit organizations. I know there's a lot of nonprofits out here. There he is, all right. And he also served on the California Board of Accountancy. Thanks for being here, Ash. Welcome. So you have a couple of statements for you, right?
Okay. Yeah, let's do it. All right, good morning. Thank you for having us here. It's a pleasure to be here. And I must say this is a wonderful event, so I really want to thank the Bobby, John Weyhgandt, and the whole Corona Chamber staff for putting on such a classy event. And I've been to several other events. And the last one that I went to that really relates to this tax was the one where the Secretary of State was invited to. And that was such a wonderful event. So I really want to thank you guys for putting on all these classy events. So I'm going to talk about the Job Cuts Act, and I'm going to refer to it as the new law. So this morning, I want to start with two famous quotes. And the first one is by Benjamin Franklin. And he said, "In this world, nothing can be said to be certain except death and taxes." However, Will Rogers says, "The difference between death and taxes is death doesn't get worse every time Congress meets." So the question I often get in the last few months is the new tax law going to help me, hurt me, or am I just going to stay the same? And my answer emphatically is it really depends on your situation. It depends on what kind of income you have, how much income you have, and what kind of planning you're going to do. So my portion here this morning, I'm going to be talking about personal individual taxes, all right, and how the new law has changed that. The changes in the new law is really a mixed bag as it relates to individual taxes or personal taxes. The tax rates are still, there's still 7 different brackets, and the percentages dropped, and the ranges within the lower brackets widened. The top bracket went from 39.6% to 37%. One bracket went from 28% to 24%. Another bracket went from 25% to 23%. So a lot of people are going to benefit. You're going to benefit from these lower tax brackets. But there are going to be some individuals who are going to jump into a higher tax bracket, and they're going to hurt. So the new law suspended the personal exemption but doubled the standard deduction. The standard deduction is the amount that you will take off of your earnings to arrive at your taxable income, and then you can calculate your taxes. So the standard deduction for singles is $12,000. For married filing jointly is $24,000. So which means that if you have nothing, if you have no expenses at all, you get a haircut of $24,000 right off the top. But if you can reduce, but if you have more expenses, called itemized expenses, you can reduce your taxable income by that much more. However, the tax law took aim at the itemized deductions, and that's where I want to spend the bulk of my time this morning. Let's start with itemized deductions. Mortgage interest. Mortgage interest, you're only allowed to take interest on loans up to $750,000. So that's a decrease from last year where you can have a loan up to $1 million. HELOCs, home equity loans, that is no longer deductible. However, real estate professionals and investors continue to receive the full tax benefit from deducting real estate taxes and interest on their rental properties. Amen. One other thing that, actually several other things, but the biggest disappointment for me and the biggest zinger was the limitation on state income and property taxes. This had me, and I'm sure a lot of the other panelists and most CPAs in the country just running, scrambling, talking to their clients. This is a cap of $10,000 on income tax and property tax. So you can only take, in the new year, you can only take $10,000 deduction for income tax and property tax. And that's going to hurt a lot of people who, in California or any high tax jurisdictions. So before, there was no cap on that. So it really had me and a lot of other CPAs just calling their clients saying, hey, can you prepay your property taxes if you can before 12/31? So I just went through a list of my clients and I said, if it's going to hurt you in the next year, just go for it. Just try to prepay it any way you can. So that's really my biggest disappointment. However, the fight is not over. I believe some states are looking into ways to get around the $10,000 cap. There could be lawsuits, et cetera. So we're not sure what's going to happen with that. A couple more things. Miscellaneous itemized deductions that are subject to the 2% floor has been suspended. This is, these expenses are unreimbursed employee expenses for W-2 salespeople. So if you're a W-2 salesperson and you rely on mileage, which is a big thing, if you travel a lot and you deduct your mileage, that deduction has been suspended. A couple more things. This is a good thing. Medical expenses, you can deduct now medical expenses that are over 7.5% of your adjusted gross income, whereas the old law was anything over 10% of your AGI. Almost done here. I only have a few minutes, but sorry. Here's a. What's that?
I'm not kicking you up.
Okay. Here's a good thing. Child tax credit. That actually doubled from last year. It went from $1,000 to $2,000. That means a credit is just a credit against your taxes, basically. So if you owe $10,000 on your tax liability, you have 2 kids that are under the age of 17, that's $2,000 per kid. That's $4,000 that you get right off the bat. So that's a good thing. So that's helpful to young families. Health insurance mandate. The new law repeals the individual mandate, the requirement that requires you to have insurance or pay a fine. But please note, this does not take effect until January 1st, 2019. So everything for 2018 is just like it was in 2017 regarding the ACA penalty. A couple more things, then I'll be done. Alimony. The alimony under the new law, alimony for agreements executed after December 31st, 2018 are not deductible by the payer, nor are they included by the recipient. So that's for after December 31st, 2018. So all of 18 is the same as 2017. So don't get a divorce. Stay married. One last thing, I was asked to speak about bonus depreciation. 30 seconds, thank you. Under the old law, you were allowed 50% deduction on new property placed in service. The remaining basis would be depreciated over the life of the asset. Under the new law, you get to have 100% write-off of the asset, and it doesn't have to be new, it could be used. And you also have the election to either take 50% or not take the write-off at all. So that is all I have for my portion. Thank you very much.
Thank you, Ash. Thank you. All right, next we have
Grace Clark. Grace is a licensed certified public accountant. Jace, come on up and join us. And she served the Inland Empire in Southern California in accounting and tax services for 35 years. Grace is a member of the American Institute of Certified Public Accountants and California Society of Certified Public Accountants, the Cal CPA. Currently serving as Vice President of the Inland Empire chapter for the Cal CPA and serves as Treasurer for local nonprofits. Welcome.
First, I'd like to thank the Chamber for asking me to speak today, and I love this event, and Heather, you rock. I was asked to touch on what's going to happen with corporations. One of the big things is that the corporate tax rate drops from, I think, about 33%, and it goes all the way down to 21%. Yeah, it's a good thing. It's a really good thing. For those of you that are operating as something other than a C corporation, you might wonder, okay, well, how is that going to help me? Well, Congress thought of you. And for pass-through entities, S corporations, partnerships, LLCs, and sole proprietors, there is a new deduction. It's the 199A deduction, and it allows you to deduct 20% of qualified net income before taxes. There is a huge caveat to this, and there are many restrictions. I want to really encourage you to talk to your licensed tax professional and get some input on this. It's a huge deduction and it will really benefit you. Along with that, for corporations, for all businesses, entertainment expenses are no longer deductible. So when you, I know. So when you take those clients of yours out to the Kings game or the Raiders game, or I'm a big sports buff, obviously. Those things are, yeah, obviously. Those things are no longer deductible. You can still deduct meals expenses, but they have to be reasonable. Bonus depreciation change for businesses, as Ash mentioned. And also, AMT for businesses has been repealed, so it's huge. This was a tax cut meant to really inspire businesses and help businesses along. And I think it's going to do that.
Thank you so much, Grace Clark. All right, next we'd like to welcome up Christopher Jonathan Ramirez, who's the owner of Christopher Jonathan Ramirez, EA and Associates LLC, a tax firm in Corona. And he is also an enrolled agent licensed by the Internal Revenue Service and has been practicing as a tax professional since 2009. He's in good standing with the tax professional community via the Southern Society of Tax Consultants and the California Society of Enrolled Agents. Welcome, Christopher. How are you? There's a microphone, I think, right there for you.
Good morning. I didn't realize we were talking about all 1,000 pages of the new tax law.
In about 2 minutes, sorry.
Well, as he said, I'm an enrolled agent, which means that I do tax preparation for both individuals and businesses, and I also do tax resolution. Okay. One thing I'm really excited about with the new tax law that Grace mentioned is the qualified business income deduction. I wanted to kind of elaborate on that a little bit. Okay, so this deduction, as she has stated, is for all pass-through entities and sole proprietors. So with this deduction, it's a little complicated, and the IRS hasn't offered a whole lot of guidance as of today. But how it's generally going to work is you're allowed a 20% deduction off your ordinary income tax, right? So that means that if you are self-employed, you're still going to be subject to the self-employment tax for the full amount. However, you're going to be allowed to knock off that 20% off your AGI, essentially. Now, the other thing to keep in mind with this deduction is that there's some caveats with it, right? So if you are a S Corp, you have to make sure that you're still paying yourself reasonable compensation. And this deduction is not considering the reasonable compensation. So it's after, you know, it's after that compensation is paid out, and it's looking at the net income of your business. Okay.
Great, thank you. You can keep that there. Well, thank you, panelists, for joining us. We appreciate your time here and the input that you have. So we've got some questions here. We're going to turn it over to audience questions near the end, but we've got some questions here that we've pre-written here. So we'll just go ahead and read a question, and who would like to answer, feel free to reach for that microphone. So first would be, is it better to operate as an S Corp or an LLC, and what's the difference?
In California, I really like S Corps rather than LLCs. And the reason is because California charges LLCs operating as a sole proprietor or as a partnership a gross revenue fee. So if your revenue is $500,000, but your net income is $20, you're going to pay a gross revenue fee on that $500,000 up to $2,500 before the minimum tax of $800. So if you're operating as an S corp or as a C corp, you miss out on having to pay that gross revenue fee. So I really prefer S corps for in California.
Excellent. Did you have one to add to that?
Yeah, I want to add to that. Which one is better, S corp or LLC? It really just depends on the nature of your business and what your income looks like. Because if you're an S corp, one thing you have to make sure, like I mentioned before, is that you have to have reasonable compensation. So if you're able to afford to pay yourself and then still have net income to have operating expense for the next few months, then I would recommend going the way of the S corp rather than LLC. But they both offer a certain level of protection.
Excellent, thanks. So when should I consider creating an S corp or an LLC? Looks like Ash has got this one.
Well, really the reason you want a corporation is to protect yourself, protect liability, have protection. So when you get to the point where you have a lot of assets, personal assets, and you feel that you need protection, you should have a corporation. You should have a S corporation or a LLC. At one point in time, I don't think insurance is going to cover it, so I think you really need to consider having a corporation. Especially if you have a lot of rental properties, you don't want to have all that on your name. It's a good idea to have like an LLC. So, yeah, I think it's something you're going to have to determine yourself to see what level you're at, and then just talk to your tax advisor.
Add just a little bit more to that. For the S corp, you want to make sure that you're compliant. One mistake I've seen a lot of business owners make is they see that the S corp offers that layer of protection, but if you're not compliant with both tax law and state law, you're able to pierce that corporate veil. And so, if you're not doing reasonable compensation, if you're not, submitting your statement of information, you're actually leaving yourself open, not allowing for that protection that you initially started that business for. So it's sort of like jumping out of an airplane without a mechanism for your parachute to go off if you're not compliant with your S corp.
In addition, many people start a corporation because they hear there's tax benefits of being a corporation rather than operating as a sole proprietor or as a partnership. And that's true because you do have to pay yourself a reasonable salary. Congress never defined reasonable. So your salary is subject to Social Security and Medicare tax, but the net income from the business flows through to your personal income tax, subject to income tax only, and not subject to Social Security and Medicare tax. However, if you're only making like maybe $10,000 a year in gross profit from this business and you have to pay yourself a reasonable salary, now what's your reasonable salary going to be? Probably close to what you're making. And so you're not really going to reap the benefits of not paying the Social Security and Medicare tax on your net income from the business. In addition, the fees that you have to pay us to file a corporate tax return, to make sure your payroll is done properly, to make sure your accounting is up to date and reasonable and correct, usually outweigh what you save in taxes by being an S corporation.
Great, thank you. I want to do one more question, and then we'll take some audience questions here. I know a lot of us were unfamiliar of how this new tax law is going to affect both sides of it, our businesses and us as individuals. So could you guys share maybe a little bit on what major changes have taken place with the Tax Reform Act to affect corporate income tax next year? Some of the things are the alternative minimum tax appeal, the maximum tax rate, deductions for entertainment no longer allowed. I know you hit on some of that. Is there anything else that we should be aware of on that?
Those are the major things that are affected in the new tax bill. Like I said, this looks like it was really written to really help businesses, but we wanted to make sure that Congress wanted to make sure that they got reelected next year, so they did do things for the individual as well. But keep in mind, this was supposed to simplify tax, but it was written and given to us by our friends in Congress who like to keep accountants fully employed.
All right. So right now I know we got Saul Shapiro back here with Liberate Debt. I think he's got a microphone, so we could open up the floor to any questions you might like to ask our panelists up here. So if you have a question like that, just raise a hand and Saul will run right over.
So I was a couple things. Any changes in retirement on the investments, IRAs, 401, anything on that in the new tax laws that are going to affect us?
The only one that comes to mind is the conversions for IRAs. So if you're converting from a traditional IRA to a Roth, you can now convert back to a traditional, whereas before, I believe it.
You have until the next year?
Yeah, I'm sorry, it's the other way around. So now you're not able to make that conversion.
Okay. So before you could, if you, oops, I made a mistake, I can go back. I have that rest of the year to do it. Now if you do it, you're committed?
Correct.
Like TJ getting married, you're committed? You can't go back. All right, got it. The other...
I think there's some things in the current tax law that they left alone, and retirement was one of the big ones. They just didn't want to touch it.
Amen. So I like that. And then the next question I had is, I was told something on the mortgage deduction for your personal residence that they're going to limit that not by the $750, but limiting it to acquisition price. So I know they talked about HELOCs, but I thought they also limited it with, I've read a couple articles on, and again, there's a lot of confusion out there. But let's say I bought my house for $300,000 and now I pulled money out, now I owe $500 on a first mortgage. I was told they're going to limit it, the interest deduction to the $300,000. Acquisition indebtedness, so to speak.
That is not what I understand. It's really limited to $750,000, and everything is grandfathered in. So if you have $1 million or $950,000 debt, you're still grandfathered in. The $750,000 is the new law. There is an exception. That exception is if you entered into a binding contract December 15th and you were able to get into that same house that you have the contract under before April 1st, you are grandfathered in under the $1 million. So that's one exception. The other exception to the HELOC is that if you can show and prove that your HELOC or your home equity loan is actually used for buying part of your house or improvements and not gambling or whatever. If you can show that, it's called the interest tracing rules, then you're grandfathered into the old law. Okay.
Well, I'm waiting for the next person to raise their hand.
I got one. My understanding is that it was always supposed to be original indebtedness or acquisition indebtedness, the deduction for the home. It's very hard to prove, except for if you go through the the interest tracing laws. It's very difficult to prove that if you refinance, it's not because you want to buy a car, you want to go on a worldwide vacation. It's very hard to prove that, but it's supposed to be for acquisition indebtedness.
Rick Box, Citizens Business Bank. Any change to capital gains tax?
No, but keep in mind that sometimes capital gains tax is the tax rate on that is 0, depending on your adjusted gross income.
Thank you.
This is related to capital gain, but keep in mind that 1031 exchanges, for the most part, they have not been touched except for personal property. You can only do 1031 exchanges on real estate. You can't do it on machinery and equipment. So.
Excellent.
One more, sorry. For equipment, you said 100%, or for depreciation 100%. Is there a limit to that for equipment?
I don't think so.
I mean, no.
100.
Like, is there
Well,
a maximum dollar amount? Like, I know with Section 179,
well,
it's up
Section
to
179 goes up to $1 million now.
Okay.
But bonus depreciation, there's no. Yeah. So what you could do, you can definitely do, I mean, depending on how much equipment you have, you can do Section 179, then you could do equipment. I'm sorry, you can do bonus after that. And in some cases, you may not want to do 100%, just because if you're in a year where you're in a very low tax bracket, and you're going to deduct this huge asset, it's better just to kind of take it over the next few years if you think your revenue stream is going to be higher. So.
Great. Well, we're going to have to cut it off right there in their respective time.
I just want
We
a
have
little
one?
clarification on that Roth. I heard there was a deadline this tax filing for conversion to Roth.
And we'll take this one last question.
I was hearing a story about someone who was going into business, brand new business with partners, and it was a big, huge plan of major revenues coming in, and they created a corporation, but they required a personal guarantee. That's my question. You create a corporation to protect your personal assets, but if they require a personal guarantee, when does that happen? Is that by whoever is making the decision, or is there some sort of, and then are you protected if you've got a personal guarantee?
That's more of a legal question, first of all. None of us have Esquire after our name. The first and foremost reason you create a separate legal entity, is for legal protection. And so I want to encourage you to talk to a business attorney. And I've got some that I can refer you to if you want to talk to me later. But yes, if you've signed a personal guarantee, it's kind of hard to make that go away or get out of that if the business goes south.
Excellent. I want to thank our presenters here. Thank you guys very much for joining us today. Great information.
So I just wanted to present to you, our theme this year at the Chamber of Commerce is at your service. So some of you have heard that. So I'm not sure if you've seen, we have a coin with the logo on it. And again, I believe a life of significance is a life when you serve other people. So I think we've all heard today, I heard someone say, I have no idea what they're talking about. Right? So exactly, that's what they're here for. That's why we have professionals talk to them later. Their information's in the back. I know they'll probably stick around afterwards, so please see them. But I just wanted to present with you a coin for the work you guys do, so when you see that, you'll be reminded, again, that's what makes life important, is when we help other people. So I appreciate your time, and thank you for being here. So appreciate that. Thank you.